When it comes to exuberance, you got to decide which market has it the worst, whether it's the equity market, the bond market, or gold. Let's break it down. 3 rate cuts are now penciled in by the end of the year, and Goldman Sachs concur with that view. Why? These markets are cashing rate cut bets that they're hoping the Fed is going to bank because of the data. Unemployment, jobless claims, the highest in 4 years at 236,000. Yes, it's a volatile number and a tough series with Labor Day thrown in, but that trumps the CPI, core CPI at plus 0.3%. Right now, this market is leaning into the slowdown in the jobs rather than the inflation. And that gives us the lows of 2025 in the bond yields, 10-year paper, sub 4% at one juncture yesterday. And yes, everybody wants to come back as Oracle with a blistering day on Wednesday, up 36%. But what is the risk of a melt-up? Well, Ed Yardeni says by the end of this year, there's a 25% probability of that very fact just happening. And that would take you to 7,000 for him if the Fed begins to indicate they are at the start of a major new cycle of cuts. Goldman Sachs come in and they talk much more about earnings, taking their target for the middle of next year at 6,900, and also saying you need the rest of the market to actually catch up. But what is gold telling you? It is the canary in the coal mine. It's the flashing amber. And Ray Dalio in Abu Dhabi actually made it very clear. 10 to 50% of your portfolio, in his view, should be in gold. It's a hedge. It's a ballast to the debt problem. But we've made 30 nominal record highs in 2025, and we have just busted through the inflation-adjusted peak of 1980 at 35.90. I wasn't even talking about markets in 1980.